Good morning from Chicago traders. It's 8:01 a.m. Chicago time on Monday, the 24th of January, 2022. Thanks for joining me today on episode number 2156. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. So this morning, clearly risk off and getting heavy at this point, getting to be strong risk off. We're seeing Europe taking a serious dive here. The Euro Stoxx 50 pushing 2.93%. And as a result, we're seeing just knock-on effects. The S&P down 148 basis points. The NASDAQ really getting its teeth knocked out. The NASDAQ's in a very thin zone that it blew through a while ago, which runs from about 14,380 all the way through to, gosh, quite a ways down actually. And doesn't look like it's got anything to lean against at the moment. So expecting NASDAQ to continue to trickle down. Overall, what's the issue here? We do have risk off liquidation. Risk assets are being dropped at the moment. A lot of this is being blamed on the tapering, removal of fiscal stimulus, the lack of passage of the Build Back Better plan. Inflation is being cited here, but man, I spent a lot of time yesterday looking at macro measures, the euro dollar, looking at the 10-year, looking at the 10 versus 2, 10 versus 1 spread, just trying to get a handle on the yield curve. The only anomaly I see is that the 20 years higher than the 30-year bond. But overall, I'm not really seeing it. I posted about it. If you're a Convergent Trading member, I posted about it last night in the Head Trader channel. And so take a look at that. This week is incredibly important for Q1. This week we have the FOMC meeting on Wednesday. We're going to get more information on what the Fed really thinks. The Fed has been quite hawkish, and more investment banks are looking at tapers in the 4 count for this year as opposed to originally a 2 count. So the dot plot is expected to kind of skew closer more into 2022 versus 2023. And so we'll see what that brings in. So the FOMC is very important, but also we have some huge earnings this week. We've got, let me rattle them off here. We've got Apple, Microsoft, Chevron, Verizon, Comcast, Philips 66, Valero, J&J, General Electric, ADM, Lockheed, IBM, Caterpillar, Amex, Nucor, SAP, 3M, Visa, and tons more. There's just some of the biggest firms out there are releasing earnings this week, and the expectation for earnings is that they're likely to guide lower or guide for earnings to stall. And the market is repricing that. Remember, the market is a pricing mechanism for balance. It is looking for that supply demand, the crossing of the supply demand curve. And so when things happen that cause more supply or more aggressive selling to take place or valuations to drop, the market responds by moving to those areas. That's where the big money is made. And so it's repricing that. So I'm not terrified. I don't feel like this is really dramatic, especially in the S&P. The S&P's next swing low is at 4260. Down below, we'll look at that in a minute. The S&P is off about 10% now, 9-10% from the all-time highs. Not a big deal. And again, when I look at treasuries, I'm not seeing anything super dramatic. I want to share this with you here for a second. just so you can get an idea of where we stand. This is a pre-market here, and you could see the big boxes, the big squares represent a higher market cap, and um, and those big boxes are all red, pretty deep red in the case of Amazon and Apple. Google's, Google's way off, and so money's got to go somewhere, and money's probably going to move into um, dividend-paying assets, uh, consumer product companies, utilities, that sort of stuff. So you'll see movement into those areas that might benefit from inflation and might be paying a dividend. So look for that. This will likely continue unless the Fed or somebody does something different, and I'm not seeing that taking place. We've really used up a lot of our power in terms of monetary policy, and fiscal policy has been such that there's been a lot of laws putting money into the market that are now being resisted by Manchin and others. So not seeing any help there, but you could see that the risk-off sentiment's pretty strong this morning, and that's where we stand. The S&P, heavy volume, 506,000 contracts. Inventory is flat, believe it or not. The inventory overnight is flat. Just as much volume traded above Friday's settlement as below. The delta is relatively flat. Let me look at it. The delta has dropped a fair amount from where it was, but we opened up and we pushed higher. We had an impulse higher, a flag, and a continuation that failed in the overnight session. And so that movement had a fair amount of volume, and now we're getting this selling, this impulsive selling down, yet the inventory is pretty flat. The range is outstanding, 115, 116 points of range. Point of control remaining up at 44.23, not shifting down. Friday's POC. Friday's POC is 44.48. The overnight's 44.27.5. So there's not much movement in value at the moment. That's going to shift as we open. But overall, we have some outstanding volatility here. Even crude is getting hit, and crude is very, very bullish. Looking at releases for today at 9:45 Eastern, we're looking for the market PMI number, the market composite PMI number. This will be closely watched. The forecast is 56.7. This is another indication of where things stand in terms of pricing. And then tomorrow we have IFO, business climate, out of Germany. Wednesday we have the Fed's interest rate decision and press conference. Thursday we have the GfK consumer confidence out of Germany, GDP growth out of the US, durable goods. And Friday we have GDP growth out of France, Germany, personal income, personal spending out of the US. So again, combined with earnings, this is a banner week. You'll want to clear your calendar and not be distracted this week and pay attention to what you're doing. In addition to that, I want to advise you to expand, to reduce your size if possible. If you are in a mini product, it's a great week to move over to the micros or nanos or whatever if you're trading Farex, and to cut your size and increase your stop and target, but maintain an R factor in the same range. This is the kind of week where we want to trade smaller and trade wider, okay? You can see the rotations have expanded. The ES is at an 8.5 point harmonic rotation, so the risk is stops have to be widened. It doesn't have to be 8 or 9 points, but they need to be widened. A 3 or 4 point stop is in the noise in this environment. You have to be quite accurate in order to maintain a position in the market under those circumstances. A quick view of Friday. Friday, I came in and I said, okay, this is somewhat overdone by normal measures, given the weekly stat, given what we had done, given the fact that we had maintained value up here. The expectation on Friday is to test lower, but to respond and get to 2017. Barring that, I was looking for it to push higher and get down into 85. Get down into 85. You can see it on the screen here. Again, these videos are on YouTube. Anybody can watch them. You can go back and review the reasoning behind it. But 85 was the target on Friday. Here's what actually took place on Friday. This is a point and figure chart. A point and figure chart. Let me turn on the fractal. So you could see that the low on Friday was 86, very close. This area here, the 86 area has a couple of confluences in it, and it did hold up pretty well for a rotation of about 30 points higher. I know a lot of people got jammed on this as they continued to trade on the short side into the closing swing or the closing range, which ended up coming in weak. If you look at Friday, we did spend most of the session underneath the VWAPs and the mids. Mids being the S stands for, there are two of them, full session and RTH, and Friday really held those levels. So you could see that we did manage to pop higher on Friday, and we did manage to take the overnight high. As I drew, Friday was exactly scenario 2 on the nose, taking out the overnight high, rolling over and getting down to 85. It did get down to 86, so I missed it by 4 ticks, but the goal is not to be accurate. The goal is to be actionable, right? We want to execute rather than be right. Our need to be right doesn't pay the bills. So with that, sentiment is at the very low, 43.90. A very weak close, basically an extreme close on a normal variation day, which means that we expect the overnight session to carry us lower. And if we look at the overnight session, let's clean this chart up. If we look at the overnight session, it just continues lower, continues the selling lower. So as we come in and see what it did on Friday, we have a nice little bounce. This was a pretty aggressive bounce. I was actually doing my homework at 5 p.m. Chicago time when the market opened, and it looked like it was likely to rotate back to this 48 up here and maybe linger at the 44.50, and it just could not get it done. It flagged and flagged and flagged, and then the Europeans came in and sold the crap out of it. And as you already saw, the NASDAQ, not the NASDAQ, the DAX and the Euro stocks are really taking a beating. They're the weakest of the indices that I'm tracking. And we are pushing into some, we're pushing into the 4,300, and we're pushing into some key areas down below. So let me pull this back. A very important and prominent MC point of control right in here at 43.43 is being exceeded. It is really, the market is not paying attention to these intermediate time frame references, which tells me that it's going to be quite volatile on the open. It's going to be, it's likely to be very whipsawy on the open. So again, this is a good day to kind of, to really turn off the noise and focus, turn off your TV, especially if you're listening to CNBC or whatever. It's just garbage in my opinion. Turn that off and just watch what is happening and how the fight is proceeding between supply and demand, or aggressor buyers versus aggressor sellers, before making a commitment. What we want to see this morning is really an attempt to either continue the sell-off unsuccessfully, or an attempt to push back, to be responsive, what we call responsive buying into that 43.85, responsive buying into the 43.85 that gets refuted. So we'd want to see some lifting where price is not following through and price is king. So in that situation, we set up some short trades. Looking at the bigger picture, since it is Monday, Let's look at the overview chart on Edge Pro X. We've got really strong separation here between the monthly VWAP and the indices. In my opinion, the market regime has changed. I'm not seeing this. Yes, we've only dropped 10, 12%, whatever, depending on the index. But I don't see a likelihood of a V bottom return and push to all-time highs. I believe there's a lot of risk overhang. There's just a lot of overhang overall. There's geopolitical. We have wars, a war, the United Arab Emirates being brought into the war that Saudi Arabia has been immersed in with Yemen. Rockets were flying yesterday, and they hit an oil refinery as well as the airport in Abu Dhabi. That's a major event. We're seeing the Ukraine-Russia crisis coming to a head. The U.S. unable to break up the tension there. We're just seeing a lot of geopolitical issues. We're seeing monetary and fiscal issues, overhangs. I believe that any rally is likely to be faded now by the big money as an opportunity to exit positions better. So we can see there's quite a bit of separation here. So there's quite a bit of overhead between where we are and the monthly VWAPs so far. So that's where we stand. Crude oil's an indication of this. You can see that crude oil is maintaining a positive separation from its VWAP. Every drop in crude oil brings in buyers, and I'm expecting crude to start working its way towards the 88, which was a swing price, excuse me, from a long time ago, $95 and $100 crude, and that's likely to cause an additional drag on earnings and on the equities. So that's where we stand. This is my trading screen, my active trading screen, and you can see there's just nothing here that has any redeeming value in terms of trying to be long. Not seeing an opportunity to be long or a clear indication of getting long. The price action is really not supportive of that. Let's move on to what's expected for today and get you guys preparing for the market to open. Stock zones turned on. A lot of room to the downside still. We took out one of the last key gaps that we had left behind from way back. This morning, we are opening in a gap down. Friday's low right in here, 85 and a quarter or so. That's Friday's low, 85.86. The expectation is an open auction that attempts to be responsive. I'm expecting this to run into a problem here with this 43.50 area, the 50. It's an old triple top, and it's a mid-century figure. If it gets to 43.50, I'm going to look for a stab short, and I'm looking for this thing to drop into 42.70 or so before the bounce. So I'm looking for 70.71 on the low. I have to flip this on you and say that this has gone quite a ways in quite a short time if you look at the composite. So don't be shocked if it suddenly turns around and starts moving up towards 44, 48 or so, which is quite a ways from where we are now. We're currently trading at 43.18, and 80 points up or so. To me, that's not something that would be too big a surprise. So, but I am looking to not fight the tape, not fight the equity heat map, and the positioning of the bigger components. Looking for this thing to trade sideways at the beginning and then go responsive back to 50, consolidate, make a higher low, and push back into Friday's range and get stalled out at the double low at the 4,400 up here for scenario 2. So this is the scenario where it gets some relief, and moves back. The key element here is to pay attention to what it does at 43.50, 51. If it gets above 43.50, 51, then you're looking at double O, and then the big price to get back into is the 48.50, which is over 100 handles up above. So not expecting that today, maybe over the next couple of days, but there's no relief. There's been no relief to this rally. And I'm prepared for it to take place. But for now, trade price. See what it's doing. Look at who's winning the fight. Look at how things are responding. If we look at, hang on. So here's an example, just a quick example. I know I'm digressing here a little bit. Let's move this up. So this is my footprint chart. This is very much what I'm looking for. See this consolidation. We have a consolidation that breaks lower, sets up a continuation short on a breakout. Then it makes this continuation trade. Then you have this strong reversal that then just completely falters. It's not able, it took out this consolidation area, which would be the stop zone on the breakout, but it's not able to climb very well, and then it trickles down. This is basically buyers really exhausting very, very quickly, running out of energy very, very quickly, and I expect much of today will have this. We'll have these strong whipsaws that really don't end up going anywhere. And so there's likely to be a lot of frustration today. Don't get frustrated. Keep in touch with how you feel. And if you're getting emotionally involved with the trade, be objective about your plan in the market and just execute what you see, not what you want. Good luck.